40% of mortgage loan officers did not renew their licenses. When I heard this information this morning from my business coach, it was like really very mind blowing information that I could not tolerate. But having somebody who is as professional as you guys are, and cross country, I see that you guys underwriting a lot of interesting different types of loans. I want to kind of like talk about professionals like myself potentially, or somebody who is having the dream and desire to start investing into real estate. But as you can imagine, their income on paper looks one way. But then when you do all breakdown expenses in the end of the day with your accountant, it shows in the end the net income on a completely different scale. So what I want to dive in today into a conversation with you, let's talk about your 1099 exciting programs, some key benefits to why is it important to borrow through that program, somebody who can definitely qualify through this program, and talk about potentially business owners who hustling and bustling all day long and really trying to find ways to earn money, who is not W-2 employees that getting paid from their employers, but somebody who runs a business, gets 1099 in the end of the day, but really wants to also get the benefits from financing and really investing or buying real estate through your company. Let's talk about that.
Yeah, I want to go back to what you said about 40% of loan officers leaving the business. See you later. So that's what it is, right? That's the business we're in. It's cyclical. The people that wanted to get into it because they saw people making money or they saw deals happening and transactions happening, they're going to be gone. And the people that will be left behind are going to be the people.
Strong survivors.
Yeah, the ones that really are in the business, the ones that do business that you can rely on. They're reliable agents, loan officers. They're knowledgeable. They know their guidelines for underwriting. They know how to make deals go from start to finish.
Beautiful.
So, I mean, I just want to say that to all the people that are leaving. I mean, we hate to see you go, but, here we are.
Yes, absolutely. Well, listen, I believe that you always get by giving, and you always have to, fulfill your engine, right, by educating yourself first and then doing exactly what we're doing right now, educating everybody around.
Yep.
So let's talk about this 1099 program. Let's talk about the opportunities that this program has to offer. And let's talk about pretty much the benefits that people could take by using this program to buy real estate.
Yeah. Yeah, this is a great program for people in our industry. It's called a 1099 program. It's a program that we offer that allows you to use just your 1099. So if anybody out there is familiar with if they drive for Uber, or if they, deliver for DoorDash, they're going to get something in the mail about how much money they made from those companies, and it's called a 1099. That 1099 document is going to have all the income you made. Now, when you go to your accountant and you give him that 1099, he's going to say, Mr. Accountant's going to say, you know what, this is great. You made $200,000 on your 1099 for driving Uber. We're going to write off $150,000 of it. So you're only making $50,000. Uncle Sam only thinks you're making $50,000. That's beneficial to you because you're saving money on taxes. Your tax burden is much, much less than it would have been if you made that full $200,000. The downside to that is from a mortgage perspective is we can only use that $50,000 to qualify you. So it's great for you to save on taxes, but this is something I do with my clients too. If they're buying a house in 2 years, I'm telling them that if they're self-employed, unfortunately, those 2 years leading up to the purchase of your home, you're going to want to pay a little bit more in taxes so that we have a little bit more income to use to qualify you. So you got to really be careful with that as a self-employed, anyone that's self-employed or like is in this gig economy that we're in, hustling on Etsy, driving for Uber, DoorDash, like I said before, this program is great for them because if you write off that $150,000
as expenses,
right? So let's say that, which is totally not something it's not a bad thing either. People really do have expenses running their business. So it's not like it's, unwarranted. It's just that unfortunately in the eyes of a mortgage company and underwriting guidelines, they don't use that to qualify you. So that's the downside. So you get cut short a little bit on the income portion of it. But what this program allows you to do is we just only look at those 1099s. So even if you made that $200,000 and wrote off the majority of it, we can still qualify you off of that full amount on those 1099s. So it's much better for somebody because we're using more income.
Interesting.
Yep.
And what type of interest rates are we talking about here?
So they're generally hovering around a point higher than where normal rates are at, somewhere in that vicinity. They're On these non-QM products, they're always going to be a little bit higher than they would for a conventional loan. That's just par for the course. I mean, essentially, if you're not providing full documentation to underwriting, it's obviously riskier for the bank. So the less documentation you provide, the more risk there is to the bank. Generally speaking, the higher the interest rate, right?
Right.
That's why if you have bad credit, you're looked at as more of a flight risk, and your interest rate is going to be higher. So same concept in terms of documentation. That's why a no-income loan, for example, the interest rates on no-income loans are astronomical. They're probably somewhere between 8, 9, 10%, depending on where you're going with that loan. But that's exactly why this program is so great, is because it's only 1% above where conventional rates are at, right? So think about it. If you're somebody that wants to buy a home and you're renting and you're paying $4,500 a month in rent, now you get to go and buy a home and your mortgage might be $4,200, $5,000, but you're in that home. When you get your taxes in order and everything like that, you can go back to your accountant, figure out a plan, maybe refinance out of this loan, but you're in a home, and it's creating that, it's getting people into a home.
Well, there is a lot of opportunities out there right now, Sam. And as you know, a lot of real estate brokers and a lot of business owners also like to invest into real estate because we believe in what we sell.
Yep.
And I think right now, with everything that's happening in the banking industry, we can talk about that as a separate subject.
Yep.
I mean, it's pretty scary to see for people, get in a position where they don't feel secure about their money. And to me personally, I think I kind of figured this out. Okay, the bank went bankrupt, great. So people will start kind of like feeling bad about keeping the money in the bank. They will start investing more into real estate. And for me as a listing agent, it's always a job to like prospect for more listings and for anybody who is ready, willing, and able to sell their property. But going back to this subject, just curious, what is the timeline? Is there a restriction on the timeline, how long you could have this mortgage for?
We do a 30-year mortgage. We do 15-year mortgages on this product. We also do ARMs, so adjustable rate mortgages. So we can do a 5-year ARM, a 7-year ARM, and a 10-year ARM. So that's also a great alternative too, right? If you know that you're planning on fixing up your finances a little bit, maybe you do a 5 or 7 or a 10-year ARM with the lower rate, because with the intention that you're going to be refinancing at a later date. So
technically there is a flexibility on timing.
There is flexibility, exactly. So and again, if you're doing the a 5-year ARM, a 7-year ARM, and a 10-year ARM, the 5-year product on the ARM is going to have the best rate.
Wow.
So think about it, right?
Because it's a shorter term.
Shorter term. There's a more, the risk is to the borrower essentially for that fluctuation in rate. Therefore, it's going to be a lower start rate for them. And essentially they will, they'll go into a product like this and say, you know what, in 2 years, I'm going to get my act together. I'm going to refinance into a conventional mortgage.
Beautiful.
So why pay more on the interest if you don't have to at that point?
Absolutely. Well, I'm always encouraging people, pay off as soon as you can. That's just my mentality. That's how I was brought up. This is how we pretty much live our life. Even though sometimes we can get off track a little bit, but it's life and everybody do. But the most important thing is how quickly can you fall down and get up back to really put your stuff together. So that's what I follow in my life.
Yep.
But let's talk about the closing costs. What are the closing costs like? Are they more expensive than average conventional loan?
They're basically the same. You have your taxes, your transfer taxes, your mortgage tax, things of that nature, title fees. They're generally going to be in the same vicinity. And like I said before, these non-QM programs that are not conventional loans, you're probably always going to have to be paying somewhere between a point, 2 points. And there's some instances where you may not have to do that, depending on where rates are at. But that's usually the only added cost to a program like this. And again, this is another easy program to underwrite, right? Think about it. We only need your 1099s, photocopy of your ID, which makes sense. We want to know who you are. We run your credit. We see things like that. We check out your credit report. We make sure everything is okay with that. And then the loan is basically ready to go.
To close.
Yeah, ready to close at that point.
Are you guys restricted in terms of and have any preference on like the lowest and the highest credit score? Does higher credit score impact your interest rate on a better scale?
Actually, on a program like this, as opposed to the program we spoke about in our last segment, basically this program, if you have a better credit score, you will yield a better yield a better rate, right? So these non-QM programs, credit is important too. Credit, I don't think a lot of people realize how important your credit is. I have old school Italian family members that go, oh, your credit means nothing, right? It's everything. And that's what they look at, right? Think about it. It's your report card for how well you manage your money.
It's your past.
Yeah, it's your past. It's how well how quickly are you paying off credit cards? Are you maintaining your debts and you paying them off in a timely fashion? Are you making on-time payments? Do you have any bankruptcies? The people don't realize how important your credit is. And I've heard people say like, oh, I'm not going to be a part of this game. Well, it's a game that's here to stay, and we have, credit is important. You have to make sure your credit is on point. And case in point, look at mortgages, right? If you have bad credit, the interest rate goes from 7 to 8.5%. You're talking about
Absolutely.
hundreds of dollars every month that you could potentially save had you managed your credit a little better. So it's very
Exactly.
important.
Exactly. Well, I'm glad you touched upon the credit subject because to me it's very, very important. Honestly, we all go through lives and ups and downs. And I did get to the point where my credit wasn't in its best shape. But now I could probably say that I'm getting close to 800.
Yeah, but you
So
fixed it.
that's,
You worked
yeah,
on it,
yeah,
and that's
yeah.
the important part. That's the
Absolutely.
important part. Now,
Absolutely.
I'm not saying that there are going to be times in our lives when we have lows. When you can't make those
Absolutely.
payments and you can't do those things, and it happens to all of us. And anybody that says that it doesn't is lying to you.
Well,
It's we all have our ups and downs. So I agree with you there. But once you fix it, work on it. That's also something that we'll do too. Is if you call us and you want us to take a look at your credit report, we're happy to help you. See where we can go with it. And if there's an easy fix, there might be something that we can fix.
beautiful. Well, credit report agency is on my next to-do list, and
Okay,
I'm looking forward to inviting them over because credit is the most crucial part. But to wrap up this segment today, I again would like to recap. So to qualify for this program, you pretty much can be 1099 employee or a business owner, I should say correctly. So you get 1099, you write off your expenses. Obviously, you need to have supporting receipts and documents
Correct.
to sustain and support all your expenses. But after all, you could pretty much get a loan based on your gross income and not your net income,
Correct.
which then makes it a huge difference. Now, Sam, just to cover one more part, are we restricted on whether or not this should be a livable property and something that you have to do the appraisal on? Or is it something that I could just buy and fix up and still qualify to get this program and potentially flip down the road?
Yeah, the way we generally will view a property is if it's habitable, right? So if there's running water, if there is heat, it doesn't have to be pretty, right? It can have, grandma's bathroom with the pink pastel tiles and things like that, which I think are making a comeback anyway. But it just has to be livable. That's the only thing. If there's, if you can see through the roof, if you can, if the windows are blown out, it might not be considered livable. So that's all you really need for this program in particular, and also like conventional mortgages, they usually require that too.
Beautiful.
So.
Well, talking about the funny part, talking about grandma's bathrooms, you'd be surprised sometimes I get approached by certain agencies that looking for this type of bathrooms or living rooms or carpeted, dining rooms. And they actually do photo shoots of very big commercials for Gucci or any kind of like big brands.
Yeah.
Pay attention to when you're looking at those pictures sometimes. They are actually a real photo shoots in real homes.
Oh, wow.
So I did at some point prior to COVID, had an agency that I used to work with, and we actually rented a property to a company who wanted to do actually a photo shoot in such property.
Oh, that's
so
awesome.
anytime there is a property with a pink bathroom, a blue bathroom, I would love to go and see them because we might potentially have a client for you.
Right.
Well, Sam, again, thank you very, very much for joining me today. Thank you for being on the same journey with me to educate public and the consumers and watch these videos, and hopefully they will reach out when the time is right for them to either buy, invest, or borrow real estate.
Awesome.
Thank
Think twice before you rip out your bathrooms.
Thank you, Sam.
Yes.